Level 1. The Intern. You are 20 years old. You go to a school where the name on your diploma matters more than anything you learned in a classroom. You applied to 40 firms. You heard back from 6. You got interviews at 3. You got one offer. One is all you need. Your first day, you show up in a suit that cost more than your rent. You take the elevator to a floor that smells like dry cleaning and espresso. The office is quieter than you expected. No one is yelling into a phone. No one is throwing paper. It looks like a library where everyone is silently betting millions of dollars. Because that is exactly what it is. They sit you at a desk next to another intern. He went to Wharton. He already knows everyone. He speaks in acronyms you've never heard. You nod like you understand. You don't understand. You will spend the next 10 weeks pretending to understand things until you actually understand them. That is the entire job. You build spreadsheets. You pull data from Bloomberg terminals and organize it into formats that senior analysts request and never thank you for. You sit in on meetings where people discuss positions worth more than your parents' house. You take notes. You highlight things. You send follow-up emails so polished they could be framed. You do whatever anyone asks the second they ask it. You get coffee without being told. You stay later than you need to because leaving before the analysts feels like a crime. The other interns are your competition. There are 8 of you. 2 will get return offers. Maybe 3 if the fund had a good quarter. Everyone is friendly on the surface and ruthless underneath. You study the same companies they study, but you study longer. You eat lunch at your desk. You read earnings reports on the train home. You dream about price-to-earnings ratios. You are 20 years old and you have no social life, and you are paying for the privilege. Your college friends are working at summer camps and traveling Europe. They post pictures. You double tap and go back to your spreadsheet. One of the interns gets pulled into a meeting with the portfolio manager. He comes out and won't tell anyone what they discussed. You feel the shift. The quiet competition becomes less quiet. Everyone starts staying an extra hour. Everyone starts sending emails earlier in the morning. You realize that this place runs on a fuel you hadn't identified until now. Fear. Not fear of failure exactly. Fear of being ordinary. Everyone here was the smartest person in their classroom. Here, you are average. Average doesn't survive. At the end of the summer, they shake your hand. Level 2. The Junior Analyst. You graduate. You start full-time. The title is Junior Analyst, but the real title is the person who does everything no one else wants to do. You arrive at 7 a.m. You leave at 9 p.m. Sometimes later. Sometimes much later. You are not trading. You are not making investment decisions. You are feeding the machine. You screen stocks, hundreds of them. You pull financial statements and build models that project revenue and earnings 3 years into the future. You compare companies against each other using metrics that would put most people to sleep. Enterprise value to EBITDA, free cash flow yield, debt to equity ratios, return on invested capital. You live inside Excel. Your fingers know the keyboard shortcuts better than your own phone number. Your senior analyst gives you a company to research. You spend 2 weeks on it. You read every earnings transcript for the last 3 years. You call suppliers. You talk to former employees. You visit a retail location and count foot traffic on a Saturday afternoon. You build a 40-tab model. You write a memo explaining why this stock is mispriced. You present it in a meeting. The portfolio manager listens for 4 minutes and says no, not the right risk-reward. You nod. You go back to your desk. You start on the next one. This will happen dozens of times before anyone says yes. Each rejection teaches you something. Your thesis was too vague. Your model was too optimistic. Your catalysts were too far out. You learn by failing in front of people who don't have time to be gentle about it. The pay is good. Better than any of your friends outside finance. Your base salary is 6 figures, and your bonus could double it if the fund performs well. But the hours eat your life. You cancel plans. You miss birthdays. Your friends stop inviting you to things because you always say maybe, and maybe always means no. You are 23 years old, and you are making more money than your parents, and you have no time to spend any of it. Level 3, the analyst. 2 years in, and the junior falls off your title. You are a hedge fund analyst now. This is where the real work starts. You own sectors. Maybe it's technology, maybe it's healthcare, maybe it's industrials. Whatever it is, you are expected to know more about the 30 companies in your coverage than almost anyone else alive. You build relationships with management teams. You attend conferences where CEOs give presentations, and you sit in the front row with questions designed to reveal what they're not saying. You call investor relations departments. You talk to competitors, suppliers, former employees. You are building a mosaic. Each conversation is a piece. Individually, they mean little. Together, they form a picture that tells you something the market hasn't figured out yet. You pitch your first real idea to the portfolio manager. You've spent a month on it. You have 60 pages of research. You have a model that accounts for 14 different scenarios. You walk into his office and he says, "Give me the thesis in 2 sentences." 2 sentences. A month of work compressed into 20 words. You deliver them. He asks 3 questions. You answer all of them. He nods. He puts $40 million into the position. You walk back to your desk and your hands are shaking. $40 million is riding on your research, on your judgment, on the calls you made and the data you gathered, and the conclusion you reached alone at midnight. For 3 weeks, the stock does nothing. You check it every hour. You refresh your model. You reread your notes. You wonder if you missed something. Then the company reports earnings that confirm your thesis exactly. The stock jumps 15% overnight. The fund makes $6 million. Your portfolio manager walks by your desk the next morning and says, "Nice call." 2 words. That's all you get. But those 2 words feel like a standing ovation. You have just learned something important. In this business, you are only as valuable as your last idea. You watch the analysts above you. You study how they talk in meetings, how they frame an idea, how they push back on the portfolio manager without sounding like they're pushing back. You are learning a language that isn't taught in any classroom. The language of conviction. Level 4, the senior analyst. You run a team now. 2 junior analysts and a research associate report to you. You divide coverage. You assign the modeling work. You review their output and send it back with red marks and the same blunt feedback your seniors once gave you. Not sharp enough. Rethink the assumptions. Run the downside case again. You are a sector head. The portfolio manager relies on you for every decision in your coverage area. When a company in your space is about to report earnings, he calls you. Not the junior, you. What are we expecting? What's the risk? Should we add to the position or trim? You answer with the confidence of someone who has spent thousands of hours inside these companies. And you answer knowing that being wrong costs millions. Being wrong repeatedly costs your career. You manage relationships with sell-side analysts at investment banks. They call you with ideas. Most of the ideas are garbage, recycled consensus dressed up in new formatting. But occasionally, someone gives you something useful. A data point you missed. A channel check that changes your view. You take the information and give nothing back. That's the game. Everyone is trying to get an edge. Your compensation is significant now. Base salary plus bonus can put you well into the high 6 figures. In a great year, it crosses 7 figures. You buy an apartment. You start wearing nicer watches. Not flashy. Nobody here does flashy. Expensive and understated. That's the aesthetic. You look around the office and notice that success is quiet. The loudest people on this floor are the least secure. The people who actually make the money barely raise their voices. You think about portfolio management. Level 5, the portfolio manager. You got your book. That's the phrase they use. You have a pool of capital allocated to you. Maybe it's $200 million. Maybe it's $500 million. It depends on the fund size and how much faith the chief investment officer has in you. You are now a portfolio manager. a PM. The letters that this entire industry revolves around. You build a portfolio from scratch. You decide what to buy and what to sell. You decide how much to allocate to each position. You decide when to cut a loser and when to let a winner run. Every decision is yours. Every gain is yours. Every loss is yours. There is no one to blame and no one to share credit with. This is the purest meritocracy in the financial world. Your performance is a number. Everyone can see it. Your analysts bring you ideas. You listen. You challenge. You tear the thesis apart looking for the flaw. Not because you don't trust them, but because the market will try to find the flaw, and you'd rather find it first. When you're convinced, you size the position. Sizing is everything. A great idea with the wrong size is a wasted opportunity. A mediocre idea with too much size is a disaster. You check your P&L every morning before your feet hit the floor. Some mornings you're up $1 million before breakfast. Some mornings you're down $2 million because a company in Asia reported bad numbers while you were sleeping. The volatility is relentless. A single headline can move a position 10% in minutes. An analyst downgrade, a government regulation, a tweet from a CEO. You can't control any of it. You can only control how you respond. The stress is unlike anything you've experienced. It's not the hours. The hours are actually better than they were as an analyst. It's the weight. The constant awareness that real money is at risk. Your money. Your investors' money. Your reputation. Every open position is a question you've answered with capital. Sometimes the market tells you you're wrong. Level 6. The Senior Portfolio Manager. Your track record is strong. 3 years of consistent returns. Not spectacular, consistent. In this industry, consistent is spectacular. Anyone can have a good year. A monkey throwing darts can have a good year. The funds that survive are the ones that don't blow up. You haven't blown up. That separates you from half the PMs who started when you did. Your book is bigger now. Maybe $1 billion. Maybe more. You manage a team of analysts dedicated to your strategy. You have a trader who executes your orders. You have an operational infrastructure built around keeping your portfolio running smoothly. You are a small business inside a larger business. The fund takes its cut. You take yours. In a good year, your personal take is 8 figures. You attend investor meetings now. Allocators fly in from pension funds, sovereign wealth funds, endowments, and family offices. They sit in a conference room and ask you to explain your process. How do you generate alpha? What's your edge? How do you manage drawdowns? You've given this presentation 100 times. You are polished. You are calm. You tell them about your research process and your risk framework. You don't tell them about the nights you couldn't sleep. You don't tell them about the position that almost took you out in 2022. You tell them the version that makes them comfortable writing a $50 million check. The politics intensify at this level. There are other senior PMs. They manage different strategies: equity long-short, global macro, credit, quantitative. You all share infrastructure and capital and a name on the door, but you are competing for allocation. The CIO decides how much capital each PM gets. More capital means more opportunity, means more compensation. Less capital means the fund is losing faith. Every quarterly review is a performance trial. You have seen PMs get their capital cut. You have seen PMs get fired after one bad year. You have seen brilliant investors lose their nerve after a drawdown and never recover. The money changes people. Not in the way outsiders think. It doesn't make you greedy. It makes you afraid. Afraid of losing what you've built. Afraid of going backward. Level 7. The Director of Research. The firm asks you to step into a leadership role. Director of Research. You oversee the entire research platform. Every analyst, every sector, every idea that flows into every portfolio. You are no longer just managing your own book. You are shaping the intellectual engine of the fund. You hire analysts. This might be the most important thing you do. One great analyst can generate tens of millions in profits. One bad analyst can burn capital and waste a year of the team's time. You interview candidates from Goldman, Morgan Stanley, JP Morgan. They are smart, they are hungry. They all look the same on paper. Your job is to find the one who thinks differently, the one who sees things that models can't capture. You build the research culture. You decide how ideas are presented and debated. You push for intellectual honesty. You want analysts who can say, "I was wrong," without flinching. You want analysts who will challenge the portfolio managers. Some funds want analysts who confirm what the PM already believes. Those funds blow up eventually. You want friction, productive friction, disagreement that makes the output better. You sit in on every portfolio review. You see across all the strategies. You see the patterns. You see when two PMs are taking opposite sides of the same trade. You see when the entire fund is overexposed to one risk factor without realizing it. You flag it. Sometimes they listen. Sometimes they don't. The market eventually settles the argument. Your own trading takes a back seat. You miss it. Level 8. The Chief Investment Officer, the CIO. You sit at the top of the investment hierarchy. Every dollar the fund deploys flows through your framework. You set the risk limits. You approve the strategies. You allocate capital to the PMs. You are the final decision on the biggest bets the fund makes. You manage risk at the fund level, not individual positions, the whole portfolio. You look at the aggregate exposure. How much are we long? How much are we short? What happens if interest rates spike? What happens if China invades Taiwan? What happens if a counterparty fails? You run stress tests that model catastrophic scenarios, the kind of scenarios that people think can't happen until they do. You talk to the founder every day. You are his right hand on everything related to investments. Sometimes you agree, sometimes you don't. The tension is productive when it works and destructive when it doesn't. You have seen CIOs fired for disagreeing with the founder one too many times. You have seen CIOs fired for not disagreeing enough. The line is invisible, and it moves. You represent the fund in public. You speak at conferences. You go on television. You sit on panels with other CIOs and discuss the macro environment. You choose your words carefully because a single comment can move markets. You once mentioned a sector you found interesting in a casual conversation. The next day, 3 stocks in that sector moved because someone in the room leaked it. You stopped having casual conversations. Your compensation is in the tens of millions annually when the fund performs. Your name is known in the industry. Recruiters call weekly with offers. Other funds want your process, your track record, your reputation. You could leave. Level 9. The Managing Partner. You are no longer just an investor. You are a business operator. The managing partner runs the fund as an enterprise. Capital raising, investor relations, legal compliance, regulatory filings, fee structures, office leases, technology infrastructure, hiring, firing, all of it. You manage billions, not millions. The fund has $15 billion in assets under management. That number determines everything. Your management fee is 2%. That's $300 million a year before anyone makes a single trade. Your performance fee is 20% of profits. In a year where the fund returns 12%, that's another $360 million. The economics of a large hedge fund are staggering. They are also fragile. One bad year and investors redeem. Redemptions shrink the asset base. A smaller asset base means less fee revenue. Less fee revenue means you can't pay your best people. Your best people leave. More investors redeem. The spiral can destroy a fund in 18 months. You spend half your time managing investors, sovereign wealth funds from the Middle East, pension funds from the Midwest, university endowments, billionaire family offices. They all want access. They all want transparency. They all want to feel like they're your most important client. You fly to Zurich, to Abu Dhabi, to Hong Kong. You sit in rooms with people who control more capital than some countries. You make your case. You show the numbers. You answer the same questions you've answered 1,000 times. Level 10. The Founder. You started this. 20 years ago, you sat in a rented office with 2 analysts and a Bloomberg terminal. You had $50 million from investors who believed in you before anyone else did. Some of them were friends. Some of them were former colleagues. One of them was your father-in-law. You told them you had an edge. You told them you could beat the market. You told them to trust you with their money. The first year you returned 22%. The second year you returned 18%. The third year you lost 4% and 3 investors pulled their capital. You learned something that year that business school never taught you. People love you when you make them money. They vanish when you don't. You kept going. You built the team one person at a time. You hired your first PM out of a bank where he was miserable and brilliant. You hired your director of research from a competitor. You hired analysts from campuses where you gave talks that sounded like inspirational speeches, but were really recruiting pitches. Every person who walked through your door was a bet. Some of them paid off spectacularly. Some of them cost you millions in bad trades and months of recovery. The fund grew. $50 million became $500 million, became $5 billion, became $15 billion. Each zero changed the nature of the business. At $50 million, you were a trader. At $500 million, you were an investor. At $5 billion, you were an institution. At $15 billion, you were a target. Regulators watched you. Competitors studied you. Journalists wrote about you. Short sellers tried to figure out your positions and trade against you. Success made everything harder. You are in your late 50s now. Your name is on the door. Your photograph has appeared in the financial press more times than you can count. People in the industry know your name the way sports fans know a quarterback's name. With respect, with envy, with the quiet understanding that what you built required something most people don't have. Not intelligence. The industry is full of intelligent people who failed. Something else. The ability to be wrong and not break. The ability to lose money and still trust your own judgment. The ability to sit in a room alone at 6 a.m., staring at a screen that says you just lost $200 million and make a clear decision about what to do next. Your wealth is enormous. 9 figures, maybe 10. You own homes in Manhattan and Greenwich and Aspen. You donate to universities and hospitals and museums. Your name is on buildings. You sit on boards. You attend events where other people with your kind of money discuss philanthropy and politics and the future of capitalism. But you still come to the office every day. You still look at the markets before sunrise. You still read research reports and challenge your PMs and argue about positions. Not because you need to, because this is the only thing you've ever done that makes you feel fully alive. The markets are the purest test you've ever found. They don't care about your name or your reputation or your net worth. They test you new every single morning. Somewhere in a college dorm room right now, a kid is staring at a stock chart on a laptop screen. He skipped a party to read an annual report. His roommate thinks he's crazy. His friends don't understand why he spends Saturday nights reading 10K filings instead of going out. He doesn't fully understand it either. He just knows that something about the markets makes his brain light up in a way nothing else does. He's going to apply for internships this summer. He's going to get rejected by most of them. He's going to get one offer. One is all he needs. He has no idea what he's walking into.